In the next few minutes, I'm going to reveal what banks don't tell you about your real borrowing capacity. I'll even show you the exact strategies property investors use to extract equity, increase their lending capacity, and keep buying when everyone else gets stuck. If you own investment property, you've probably hit this point. You've got equity sitting there, the property's grown in value, but when you go to the bank to buy your next property, they say no. Or they give you a number that's way lower than you expected, and you're left wondering, I've done everything right. Why am I stuck? I'm Nick from Trellis Finance. I've spent over a decade helping property investors structure their lending so they can scale up without hitting the walls the banks put up. And what I'm about to show you are 3 things that banks assess that most investors have no idea about, and the step-by-step process to unlock capacity you didn't even know you had. Let's get into it. First, here's something most investors don't realize. When you buy a property, the bank will almost always value it at the contract price, even if your property is actually worth more. Let me show you what I mean. Say you buy a property for $800,000. You've done your research, you've done your due diligence, you know comparable sales in the area are sitting at $850 to $900. You're thinking, great, I'm under the market value. The bank's valuation will reflect that. But here's what actually happens. You submit your contract to the bank and they order a valuation. 95% of the time, the valuer will come back with the figure at or very close to your $800,000 contract price, even though the market data supports a higher number. Why? Because banks are managing risk. If you overpay for a property and default, they want to make sure that they can recover their loan. So they anchor the valuation to what you actually paid, not what the property might be worth in the best case scenario. This is a bank policy most brokers won't explain to you because they don't deal with it at the portfolio level. Now, this doesn't sound like a big deal when you're buying your first property, but when you're trying to scale up and buy your second, your third, your fourth, this becomes a massive bottleneck because the equity you think you have, the bank doesn't see it the same way. And that's just the first layer.